I'm Chantel Leeson, and welcome back. We're investing for the unpredictable. My special guest today is Stuart Kruse. He's a certified financial analyst and CEO for Kruse Asset Management. How are you today?
I'm doing great. How are you doing today?
Wonderful. Thank you for joining us.
It's my pleasure. Thanks for having me.
You're quite welcome. What's your subject we want to talk about today?
I'll give you an example. There was a structured product that we used that was based off the lesser than. So the worst index you could have between the S&P, the Dow, and the Russell. So two large cap indexes and small cap index. And you got the worst performer. And you would say, why would I want the worst performer? Well, if the worst performer was positive, you got a leveraged upside of 1.4 times that number. So in 5 years, if it was up 40%, your return was 56%. If it was up 50%, your return would be 70%. On the other hand, if that worst performer was negative, you got the positive version or the absolute value version of that return. So if the worst performer was down 20%, you got a positive 20% return.
Wow.
Sounds awesome. Now, that goes to a point of down negative 30. And if it was down negative 30, you would get a positive 30%. But if it was down any more than that, 30.001, you got the full loss, just as if you had invested in the index. So again, going through the math and looking over the last 50 years, that happened one time. So the odds of having a positive outperformance was literally 99.8% with a 0.2% chance of a loss. The worst loss would have been down 36%, but the expected value was that you would outperform your index 70% of the time, and that your average return was about, it was going from memory, but about 11% versus 9% for the S&P. So very low risk of loss, average expected return higher per year, much greater chance of positive outcome, but that only works really if you ladder them in over time. So when you ask me, how did they do well? Those dual directional notes did awesome. If I looked at the ones that were only 2 years out, they did horrible. Their average returns were in the 3 and 4%. So it really depends upon the underlying. But kind of a question which I will ask for you is, where's the risk? Because these notes, in theory, take on the risk of the issuing bank. So if JP Morgan issues the note, you, in theory, take on the credit risk of JP Morgan. So what I would argue is that given what we just went through with the COVID lockdown, and what we went through in the financial crisis, where the banks were too big to fail, and the banks were bailed out every step of the way, that there is almost no risk. I can certainly not say there's no risk, but the Fed has set up a precedent that they will not let these large banks go out of business, so that the marketplace will have a smooth and operating financial, financial system, right?
Exactly.
There was one bank in the financial crisis that I worked for that went out of business. That was Lehman Brothers. Everything else was purchased. So Lehman Brothers was actually allowed to go bankrupt. So if you had a structured product issued by Lehman Brothers, in theory, you took on their credit risk. And if Lehman Brothers went out of business, in theory, so should have that structured product. But all of those dollars were paid and made good. So in the only example of a big bank going out of business, in which case they could have lost money, all of the notes were paid. Because Barclays came in and bought Lehman Brothers, bought all the assets, everything was money good. So I'm not aware of a large bank having ever defaulted on a structured product in the last several decades. So I would say this is pretty well guaranteed and backed.
You know what this says for the average investor, because that's what we worry about risk.
For sure.
You've clearly defined that they've minimized that risk, or in some cases, they even eliminate the risk.
Right.
And I think what's happening is that when you're talking about retail advisors, they don't even recognize that it's not as risky as it appears to be.
Right.
That's the biggest fierce risk. And I think that the compliance officers who approve whether a product can be bought or sold within the house, that's what it is. They don't understand them.
That's usually the case. If you don't understand it, then they just say, no, we'll just take away all the problems. We just, no, you can't use this. So
it also minimizes what happens to the client's portfolio over the long term.
Right.
Part of the asset, you're doing asset allocation, you're looking at something that's going to give a client a little more upside potential and less downside risk. That's what you're looking at, something like a structured note, structured product.
100%. 100%. Now, I'm a little self-dealing here because I'm an independent advisor, but I would recommend if you're going to be buying these things to go through somebody that's more independent, because if you're going to a JP Morgan or Goldman, they're going to suggest that you buy their product, right?
Exactly.
And of course, nobody has the market cornered on the best. JP Morgan, I buy a lot of those particular kinds of notes, and they're very good at, I would say, the dual directional notes, but maybe not so good at the principally protected notes, right? And so you want to find the best option available. So that's why you probably want to go through an independent advisor.
Wow. Stuart, you've covered a lot of information today. What I'd like to know, how can someone reach out, and I'll help you put in the chat box, what's the best way for people listening on the our presentation here, how can they reach out to you?
Our website is kruseassetmanagement.com. That's Kruse, the word assetmanagement.com. You can reach out to me at Stuart@kruseassetmanagement.com or on LinkedIn, which is at KruseAM. So LinkedIn.com, KruseAM.
Now, do you work with other financial advisors who are looking to leverage? And the reason I ask this question, sometimes financial advisors recommend someone, and they're not, this is when they're not selling out the house or not selling, they look for someone else who can help a client because their clients are asking for something they can't sell. Do you reach out with their financial advisors in that way?
Sure, we work on a team-based model. We have products that we've been running for 15 years. We have some very quantitative-based strategies that I use with other financial advisors. I've used some of their products as well. I collaborate with them. As I said, on a team-based model, I generally don't sell insurance or annuities or whatnot, but I have teams of experts that I work on it, with them as well. So yes, I'm happy to talk to anybody about how we could collaborate.
Wonderful. Yeah, before we wrap up, we've got about 2 minutes left. What else do you think people out in the public here want to hear about your company and the products you're offering? Or at least about structured products?
Yeah, it's all about structured products. We've been also doing a lot of things and giving access, in addition to structured products, to like venture capital and private equity. So those minimums are coming down, and when you get closer and more access, and working with some other higher level groups, we've been able to provide access to some of our clients and non-clients to some amazing private equity deals recently. So that really helps the risk reward profile of our retail investors. Ties up the money a little bit, but long term, again, it really helps out with the risk adjusted returns.
Well, Stuart, before we wrap up here, one other thing. I don't want this to be a one time. Can we get you back in the future?
Absolutely. I'd love to see you again.
Wonderful. This has been great talking to you, and I'm very happy with our discussion today. I think our public's learned a lot.
Good. Glad we could help.
I look forward to seeing you again.
Okay, take care.
Bye now.